Hey guys, how's it going? Today we're going to be doing the second part of our valuation series. Today we're going to be going through two methods from this book and then another method based on historical ratios, like historical price to earnings ratios. So we have a lot to cover. I'm not going to waste your time. Let's get straight into it and let's head to the spreadsheet. So let's get straight into the owner's earning valuation method. With the owner's earnings valuation method, you're taking the perspective of a business owner. You're looking at the company as if you want to own the whole business. The owner's earnings is the amount of cash that a business owner can take out of the business without negatively impacting the business. The business owner can take out this cash and the business will remain steady. It won't grow, but it also won't decline. So it'll be maintaining itself and the business owner can just take this cash out of the business. And this is one of the things that Buffett is actually known for. It has nothing to do with growth rates or looking into the future. It's just the amount of cash that the business owner can take out now. And how this valuation method works is you take this number, the owner's earnings, and you times it by 10. That's a reasonable value that you should pay for the company. If you pay 10 times the owner's earnings, each year you're going to get at least the owner's earnings, so you're going to make around 10% of your money. So for example, if owner's earnings is $10,000, you would want to pay a reasonable price would be around $100,000 for that business, because each year you can take out $10,000. So every year you're getting around 10% of the money you invested. That's how you can think about this method. That's why it's called the 10 cap method. No company will have owner's earnings in their financial statements. This is something you actually have to calculate. So I'm going to read you straight from the book from what Buffett actually defines owner's earnings as. So owner's earnings is reported earnings plus depreciation and amortization, as well as some other non-cash expenses. And then you minus the average amount of annual capital expenditures that allows the business to keep running and maintain its competitive advantage. So if you don't know, depreciation and amortization, depreciation is if you own a bunch of assets, over time these assets lose values. That's depreciation. And in financial statements, this is counted as an expense. But however, in a business, you're not actually paying depreciation costs. It's a non-cash expense. So as a business owner, you can actually add this back from your net income to actually obtain the amount of cash that you have in the business. And amortization is sort of the same thing, but it has to do with intangible assets, like the brand of a company or the value of some of their patents or things like these. You then also have to take into account changes in accounts receivable. Accounts receivable is the money that is owed to the business, and accounts payable is the money that the business has to pay to its suppliers. Changes in these accounts receivable and accounts payable does affect the amount of cash that a business has in a given year. If accounts receivable goes up, it negatively affects their cash position because they're owed more money, which they still haven't received. However, if accounts payable goes up, they're in a good position because they haven't yet paid that cash to suppliers, so they're in a good cash position. And then you add back income tax because you want to have the owner's earnings pre-tax because you're thinking like a business owner, and for a business owner, the most important thing is the pre-tax numbers. You might be wondering, where do I find these things in the company's statements? Where can I find these numbers? What you do is you want to go to the SEC's website. You then want to enter the company's ticker symbol. So we're going to use the same company as last time, Budweiser. And since Budweiser is a foreign company, they don't have the regular 10Ks and 10Qs, which are the annual and quarterly reports. They actually have a 20F, which is their annual report. So then you just do exactly what I did. And then you can search consolidated statement of cash. So you want to go to the cash flow statement, and this is what it looks like here. So the first line is the net income that the business has produced in a given year. So we can see that in 2019, it was 9.9 billion around. We take that number and we put it here. We then can now add back the depreciation, amortization, and impairment, which was 4.6 billion. So we add that back here. Decrease or increase in trades and other receivables. This can represent their accounts receivable. So you can see it decreased by 258 million. So we want to actually decrease the change in accounts receivable by 258 million. And then we look at the next one, which is increase or decrease in trades and other payables. So this is 679 million. So then we add that back. And then for the income tax, you can actually go into the income statement. I think that's a better representation. Yeah, and you look at the income tax expense for that year, which was 2786, which is what we actually used here. So with owner's earnings, you're meant to use the maintenance capital expenditure. However, when businesses show their capital expenditure in their financial statements, they don't distinguish between the capital expenditures needed to maintain the business and the capital expenditures to grow the business. So you sort of have to estimate this, because if you have the total capex, it's broken up into maintenance and growth. So you want to try and identify what is the maintenance capex. So the maintenance capex will be less than the total capex for the business. So if you want to be more conservative, you can actually just use the whole capex. If you do understand the business really well that you're analyzing, you should be able to find out the maintenance capex. But in this case, I'm just going to use the total capex. If we go back to the cash flow statement here, so the capital expenditures, another way to look at that is the acquisitions for property, plant and equipment, and intangible assets. So we can see that they spent around 5 billion and 174 million on these capex expenses. but they also sold a bit of them. So 320 million they received from sales. So I got the net value of that, and that was 4.8 billion. So that's what we do here. And then once you add all of this up, we actually get an owner's earnings value of 13 billion. If you own the whole AB InBev business as an owner, you would be able to take out around $13 billion in cash each year. So now we can times this by 10 because we want to receive at least a 10% return on our investment with this method. And this gives us a 10 cap price of 130 billion. We then take the market cap and divide it by the number of shares to get the price we should pay for each share. And so if you guys see here, I have a 10-year growth rate for the shares, because if you look at AB InBev shares over time, they've actually risen because companies sometimes do issue more shares to raise more money for their business. So in 2010, they had 1.6 billion shares, and now they have almost 2 billion shares. So we have the one version where we grow the shares in the future to expect the same amount of issuing of shares, because when companies issue shares, you as an owner get diluted and you own less of the business. However, if a company, for example, doesn't have any growth rate of shares, or their shares are actually reducing, you can actually just reduce this completely and you'll just use the current shares they have today. And you can see the price changes significantly. So before, when the shares were actually growing and we took that into account, the fair value today is around 52. But if we don't expect the shares to grow into the future, the actual fair value today would be around 64. So it does make a huge impact. And that's why you want to be looking at if a company is issuing more shares, if they plan to issue more shares in the future, because that can affect your fair value estimate of a company. So if we look at how the shares grow over time, we can use this calculation that I did here, where you take the ending value divided by the starting value, raise it to the power of 1 divided by the number of years, and minus it by 1. And we get around that the growth rate of the shares each year is around 2%. So if you want to get the growth rate over a 10-year period, in this example, I just use a 2% growth rate each year. So it gives us around a 21 or 22% growth rate over a 10-year period. So that's what we're using for the shares because we're trying to value the business into the future. It's just a bit more of a conservative way to do things. And then you get the value per share today. Only problem with this owner's earnings method is that it doesn't take into account growth, which can be a good thing, because if you're able to buy a business at a good price today where it's undervalued without taking into account growth, that's a really good thing because you also get the benefit of the growth, which you're not taking into account. However, I did do a similar calculation with a company like Google. I did the same process that I just showed you with AB InBev. Their value per share today based on their owner's earnings is extremely low. It's around $350 today. Companies like Google and these tech companies do have a lot of their valuation based on their future growth, because the growth is so important for these companies because they grow so fast. A method like owner's earnings wouldn't work very well for high growth companies. It would work more for stable companies that don't grow as fast. So the other method that we're going to go into is the payback time method. You're taking the company's free cash flow and you're growing it into the future to determine a valuation for this company. So free cash flow is the amount of cash that a business generates that the business can then decide what to do with this cash. They can either give the money back to shareholders in the form of a dividend, they can keep the money for a later date, or they can reinvest it back in the business to grow. You have the cash that the business generates from operations, and then you minus the capital expenditures, which is the amount of money that they're spending on maintaining their position and also growing the business. And then they have the cash left over, which is known as the free cash flow. And the difference between free cash flow and owner's earnings is that owner's earnings is meant to not take into account growth, whereas free cash flow is meant to take into account the growth capex. So usually you'll find that the free cash flow is actually less than the owner's earnings. As we can see here, our owner's earnings was around 13 billion, but our free cash flow here was around 8.2 billion. So how this method works is we're taking the free cash flow initially in the current year, and then we're growing it by a growth rate. And we do this for 8 years. We do this for an 8-year period. And the reason why we're doing this for an 8-year period is because Charlie Munger, he says that one good way to value a business is valuing it based on its 8-year cumulative free cash flow, because private businesses usually trade around this value. They usually trade around 8 times free cash flow, whereas public businesses trade around anywhere from 10 to 16 times free cash flow. This method has a sort of a margin of safety already integrated into it because you only want to pay around 8 times free cash flow instead of the usual 10 to 16 times free cash flow that you would usually pay for a public company. So you're taking this as a perspective of a owner of a private company. And so if you can get a good valuation by looking at it as a private company, you know it's going to be a good valuation for a public company as well. What we're doing here is we're choosing a specific growth rate. So for example, if I change this to 6%, and then we grow the free cash flow every year by 6%. In year 1, it's 8.2 billion, then 8.7 billion, and so on and so on. So this column shows you the additional free cash flow we get each year based upon it growing by this specific number. If I change this to 1%, there would be very little growth, whereas if this changes back to 6%, you see it would be a lot higher. And then this column is the cumulative free cash flow throughout the period. So in the first year, the free cash flow is 8.7 billion because that's the free cash flow grown at 6% from the initial year. And then this just continuously adds the cash flows together until we get a free cash flow around $86 billion. So what this means is that over an 8-year period, AB InBev, if free cash flow is expected to grow at around 6%, they would have generated around $86 billion in free cash flow. So this is one way to value the business, because you can think of a business as just the sum of its present and future cash flows. We can now take this number, divide it by the number of shares, which we have over here. This is the number of shares that AB InBev has. So we take this number, we divide it by the number of shares, and we get a potential price that could be used as a fair value for AB InBev based on their future cash flows. And so the last method where I'm going to discuss today is the historical ratios method. It's quite simple and intuitive. So companies in the stock market are valued based on different metrics. So for example, their price divided by their earnings, or their price divided by their sales, their price divided by their equity or their book value, which is just their assets minus their liabilities, and also their price divided by free cash flow. So all of these things have different multiples attached to them. So for example, AB InBev over a 10-year period has traded for around 18 times their earnings. If AB InBev made $1 million in earnings, if they're trading at an 18 times multiple, their entire valuation for the company would be around 18 million. So how this method works is that you can look at their historical ratios over an historical 10-year period to determine a sort of average. This is sort of to determine like a baseline for what the company should be at. And then what you can do is you can look at the current valuations today, and assuming that the company will get back to those levels, you can see if a company is under or overvalued. But this does have the one strict assumption that the company does reach back to its previous valuation levels. This may or may not be the case, because the ratios that a company is given does really highly depend on how the world and the financial community values and sees the prospects for that company. One really good example of what I mean by this is looking at Apple. So in the years of around 2013 to 2016, the financial community had a very sort of negative outlook on Apple. They didn't know what their future would look like. They didn't anticipate their new sort of business models and the continuous strength of iPhone sales. So they were valued at around 10 to 12 times earnings. Now investors currently believe that Apple will grow a lot faster and does have a better financial future. They're valuing it at a higher earnings multiple. So now it's valued around 23 to around now crazily 34 times earnings. We can go to the website I showed you guys last time, which is Macro Trends, and we can look at AB InBev. We go on their price ratios. We can see here that they have their price to earnings ratio, price to sales ratio, price to book, and price to free cash flow over 10-year periods. I'm just going to show you guys how you can get the historical average over a 10-year period. So we have their price to earnings ratio. You can then highlight all this data here, take it into Excel, and we just want to find the average over this period. So these are the actual price to earnings ratios over this period. So we just highlight them all and we make it into a sum, and we can see that there are 34 values in here. So then we can divide this sum by 34 to get the average. So here they're telling us that the average is 32, but that's because they have this value of 88 here and 79. What I do generally is just take out the extremely high valuations. So you can see it's around 18 to 19. So you get a more realistic picture by taking out the extremely high values to get an average for their ratio in the past. The valuation multiples that the financial community places on companies can change over time. So this is sort of one of the downsides of this method, but it does sort of give you a decent insight into if a company is over or undervalued based on its historical metrics. The current PE for Budweiser when I made this was around 32. And like I said last time, 50% of the revenues are sort of gone because of the coronavirus. And I don't think it's actually representative of the actual company and its strength. So what I did was I took the price and divided it by its average earnings per share over the past 5 to 6 years, which is around $3 per share. And this gives you a PE of around 15. So we can see that if we were to take the historical and minus it by the 15 PE, and divided by the historical, we get a difference of around 16%. If we're looking at it from this perspective, it means that AB InBev is sort of undervalued 16%. In terms of price to sales, how I actually got these is you can just go on the Morningstar website, you can click on valuation, and they also have the price to book, price to sales, and price to cash flow currently. There is around a 13% upside if you look at the current ratios today and the past ratios historically. That is one way to just look at these sort of valuations. If you were to take their historical value and times it by their average earnings over the past 10 years, you get a value of around 67. If you were to take the sales of AB InBev today, which is what I did here, if you take their revenue today, which is around 52 billion, if you take 52 billion and divide it by the number of shares and then times it by this price to sales multiple here, you would get around a value of around $74 per share. And if you do the same thing with price to book, their current book value is 35.84 from the previous year. It would be around $71. So you get the average is around $71. It may not be one of the most accurate methods. It is really good to apply a margin of safety to this method. So the higher the margin of safety you make it, the lower the actual value of the company today that you should buy it at. So at 30%, it's saying around that the value of the company is around $50 per share today. And we can see that from the 4 methods that I've shown you guys, the margin of safety method, which gave it a value of around $34, owner's earnings gave it a value of around $52, the payback time around $42, and the historical ratio is around $50. So all these different methods give you sort of different perspectives into the valuation of the company. The margin of safety looks at the earnings into the future and then discounts it back to the present. Owner's earnings looks at it as if you're a business owner and just want to take out the cash from the business, and it doesn't take into account growth rate. Payback time looks at free cash flow growth rate and tries to determine a value based upon that. And then historical ratios just looks at the average ratio over the past 10 years. You can compare that to the current ratios today and see if it's over or undervalued. So there are just sort of different ways to look at a company. These different ways do give you a better idea of what a more accurate valuation for the company is, because some of them may be a bit too conservative and some of them may be a bit too optimistic. So sort of using an average with these is a good idea. And that's what I have done with my calculations for AB InBev. The idea with these valuations is to sort of get into a ballpark range where you're confident in your valuation, but you're never going to get it exactly right. Some of these valuations may be very off, and there are many different ways to value a company. And I certainly have not mastered any of them yet. I still do have some problems with owner's earnings and some of those things. You're never going to be able to get it correct, and you're always going to learn new things about a company. I'm going to keep showing you guys what I'm learning when I'm learning it, so you guys can also learn with me and learn these different valuation methods, because it is super important if you are investing in individual companies to sort of have an idea of what their valuation is. If you do have any questions about these valuation methods, do let me know in the comment section below. And if you do have any ideas for other videos, also let me know in the comments, and I really appreciate that. Thank you guys for all your support, and I'll see you guys next time.